All right, I think KK is back with us. So, KK, good morning. We were trying to get a sense from you on where we stand currently. Markets continuing to look healthy. The mood continues to be intact as well. When we're talking about looking ahead, what are you pricing in? What are the opportunities that you're focusing on currently?
Yeah, I think market is building in a lot of optimism at this point in time in terms of the economic recovery. And I think we are building in a lot of growth into FY22 and FY23, which is something that we need to be a little cautious at this point in time. A lot rides on what the government and RBI will do, because on the ground there is still some amount of stress that we are seeing across different loan products. We need to see some resolution through a one-time restructuring or a scheme that we believe will happen, that could provide a tailwind for the next leg of markets. The financial institutions are getting recapitalized very well, given the appetite and liquidity that is available at this point in time. So that is removing a baseline risk in terms of institutions getting stressed, given the good capital availability. I think we are building in a lot of confidence into the way the government is approaching the reforms. We think that this strong shift of manufacturing into India is finally going to happen in the next 5 years. We've been waiting for it for quite some time. So I think we are building in a lot of optimism on the manufacturing sectors of the Indian economy, both from a local and from a global perspective. We think a lot of FDI, a lot of MNCs coming into the country to capture the opportunity here is definitely going to play out. The PSU divestment is a big step in the right direction, which will help the government to address its own fiscal situation and provide the thrust to the productivity and the growth in the economy. So a lot of it rides at this point, I believe, on the government's intent and will to make this happen at this point in time, along with the support of the RBI.
Okay, interesting. It's interesting that you're talking about that, KK, and since you've also just touched upon the RBI, let's get a check on the health of the financials as well and how you're assessing that currently. We've seen, quite a substantial amount of fund infusion or fundraising across the major banks, prepared for any kind of vulnerability over the next few months. And we've also got some more high-level meetings that are slated, including today with the Prime Minister and heads of banks as well. What's your assessment of the financials currently?
I think, clearly there is a lot of stress on the ground, but it's kind of ebbing, as we see from improved moratorium numbers reported by various banks and NBFCs in the June quarter compared to April. That's a good sign. As more economic activity picks up, the ability to repay the loans and the EMIs is going up. So collection efficiency has been reported to be getting a lot more significantly higher, closer to normal. So with the economy normalizing in the next 6 months, the stress in the system should be a lot more lower than what we see today. The capital rise, done by all the banks is going to be a big differentiator this time around, because the banks and NBFCs are raising capital ahead of times and preparing the buffer for provisioning, for growth, etc. So these are positives, basically. But given the huge amount of paper that's coming through, we do not see a significant outperformance of the banking sector at this point in time. We see that banks will be an enabler for the economic growth in the environment, and we should play it through the various industries which are going to be beneficiaries of a low interest rate and a good credit growth environment that we will see for the next 3 years. So that's why I again reiterate that we should look at the manufacturing sector, which will see some uptick, along with the fact that the long-term consumer discretionary dynamic will start to take over from here. Because 70% of consumer discretionary essentially is driven by the top 20 households in terms of per capita incomes. So we believe.
Put him down here.